A global equity index fund is the rational, sensible, smart choice if you want to have a successful investment experience. And in this video, I'm going to share the what, why and how of a global equity index fund so you can win with your money. And if you want to know about the basics of investing, you might want to check out my earlier video here. I'm Jason Butler and I'm a chartered financial planner with over 30 years experience of advising people on their money and also building my own wealth. So what is an index fund? Well, it's either an exchange traded fund, which is traded on a stock market, or it's an investment fund provided by an investment house which aims to match or replicate the holdings of a major stock market index. So for instance, like the FTSE 100 or the S&P 500. But there are also lots of indices that cover smaller areas and more esoteric areas of investment. Now, a global equity index fund enables you to invest in companies that are all around the world. So as well as having the UK, companies based in the UK, we also have companies that are based in America. But also we have companies based in Europe, China, India, the Far East, Australia, and South America. And that's what we have. We have a spread of companies that are all around the world and we put them all together, and that is the beauty of a global equity index fund. So why should you invest in an index fund? Well, there are a number of reasons. Firstly, cost. They tend to be 1/5 or less the cost of actively managed funds. That means that you get to keep more of the returns that markets deem to give you. And remember, with investments, you get everything that you don't pay for. Investment returns are not certain, whereas costs are definite. And you must remember that few actively managed funds ever beat index funds. And even those that do rarely go on to continue to beat them in the future. And they're balanced. It means that you have a spread of companies in different regions, in different areas of the world. You're not putting all your eggs in one basket. It's what we call the no regrets approach. It means that you get whatever the markets deem to give you. It doesn't mean that your money doesn't go down when stock markets go down, but it means that you get returns over the long run that are there for the taking. Another reason is that they're really simple. They're really easy to understand. There's no active fund manager to die, retire, or make silly mistakes and big bets with your money. It does exactly what it says on the tin. It gives you the return from the stock market indices that you choose to cover. And don't just take my word for it. There are many investment experts who also are proponents of index investing. Jack Bogle, who was the guy who basically invented the index fund in the 1970s, he said, don't worry about buying a needle in a haystack, which is what you do when you're trying to pick stocks or individual companies. He said, just buy the haystack, which is the market, the index fund. And Warren Buffett, one of the most successful investors ever in the world, says that for most people, the S&P 500 is a good enough investment and will give them a great experience. So how should you invest in an index fund? Well, you've got a choice of choosing an exchange traded fund or an investment fund. Now, for most people, and particularly if you're investing regular and modest amounts, you should probably go for an equity index fund. And that's because the overall costs of buying into the fund are much less than if you're buying an ETF, an exchange traded fund. And also another reason is investor protection. If you buy a UK domiciled global equity index fund, then you will have much higher levels of investor protection than if you buy an ETF, an exchange traded fund, because they're based in Ireland. And the investor protection in UK based funds is £85,000, whereas an Ireland-based ETF is only 20,000 euros. So for that reason, I recommend that most UK-based people who are building up regular investments into index funds invest via a UK-based global equity index fund. Now, there are three providers of UK equity index funds. There is HSBC, and that is the cheapest, and it's UK-based, so it has the highest investor protection. Then there's MSCI, and that is an ETF based in Ireland, so it has lower investor protection. And then there is Vanguard. And the Vanguard fund is UK based, and it has about a 5% bias towards smaller companies. So it might have the potential to produce slightly higher returns in the long run. And indeed, over the last 3 to 5 years, it has done that. Whether it does in the future, who knows? But there's also another option, and that's called the Vanguard LifeStrategy range. Now, the Vanguard LifeStrategy range has anything from 100% world equities all the way down to 20% world equities, with the balance going into bonds. And it also has a 20% bias towards UK equities. So if you want a bias towards UK equities and possibly you want to add some bond exposure, the LifeStrategy range is a good bet, but it will probably produce lower returns than the other three funds that I've mentioned. I invest in the Vanguard LifeStrategy range, and so do my family. But that's my choice. Remember, if you're in any doubt about the investments that you should be making, please consult a regulated independent financial advisor who can help you figure out your plan and your investment strategy. There is no magic to building wealth. You have to regularly save, you have to invest, and you have to be patient. And you might like to check out this video on the difference between saving, investing, and speculating. See you next time.